Hey, most of you have a retirement account. You're putting money in, let the money accumulate, and then someday when you retire, you put the money out. But there's a lot of things that you need to know of the complexity of some of these retirement accounts, so you don't want to miss today's show. Al and I are going to break everything out for you so you don't blow up your retirement. Welcome, everyone. Show's called Your Money, Your Wealth. My name's Joe Anderson. I'm a certified financial planner. That's Big Al. He's sitting right over there. Both of us work for a company called Pure Financial Advisors. So when you're looking at your retirement, there's a lot of things that you need to know, because most of you have a retirement account and you need that to fulfill your overall retirement dreams and goals. Do not blow this up. That is today's financial focus. Here's why we're getting to a master level type education today on retirement accounts, because here's the deal. We got $24 trillion in retirement accounts, $24 trillion. And most of that $24 trillion is sitting in IRAs, individual retirement accounts. We got 17% in 401k accounts. Then we got private defined benefit plans. Over 50% are held by you, the individual, and you need to know how to start taking these dollars out, because if you do it wrong, it's going to be 100% taxable and your retirement dreams are over. That's what we want to get into. So when it comes with taxes, let's bring in a guy that knows a heck of a lot more than I, Big Al Clopine.
How to master your IRA. That's what we're going to get into today. So let's start with whether you should roll your 401k or 403b into the IRA, or whether you should keep it in those respective plans. Then we're going to get into a technique that not all of you have heard of, but if you have company stock in your 401k, there's a strategy called net unrealized appreciation. It's a pretty good one. It can save you some tax dollars. Required minimum distribution, RMD aggregation. We're going to get into how you take your required minimum distribution, how you calculate it, and some mistakes people are making, and you don't want to make those mistakes because the penalties are pretty big. We'll get into stretch IRAs. This is when you actually pass away and the kids get the IRAs. They can stretch them out over their lifetime, but there's some things that you and they should know about. And then finally, we're going to talk about beneficiary mistakes, because it seems obvious. You know, you name your spouse and maybe your kids as contingent beneficiaries. This gets missed all the time. We're going to tell you some common mistakes. So Joe, and as you've said, IRAs are such an important part of our retirement. We need to get these things right.
Well, I mean, you got $24 trillion sitting in those accounts, and the IRS is basically waiting for three things to happen, right? Yeah. They're waiting for you to reach a certain age, right? So you have to start taking the money out. They're waiting for you to make a huge mistake, and then they're waiting for you to die. And so when you die, there's a lot of different things. And each stage of life with these retirement accounts, if you don't follow the rules correctly, I mean, it could have mass destruction on your overall retirement account. So let's dive in. Let's first of all, how the heck do you get money into an IRA, Al?
Yeah, I think that's important. So right off the bat is contributing to your IRA. Of course, you can contribute $5,500 per year, or $6,500 if you're 50 and older. Another way to get money into an IRA, this is what happens for a lot of people, is you've accumulated money in your 401k and your 403b, and then you retire and you roll it into the 401k. So Joe, that's probably where the majority of money gets into IRAs, is from 401ks, 403bs.
Sure, I mean, $5,500 or $6,500, you can accumulate some money, but when you look at these big 401k plans or pension plans, now you're talking about hundreds of thousands of dollars that are getting rolled into the plans. So one of the bigger questions that you might ask is that, all right, well, now I have my 401k plan. Do I roll it or do I keep it? There's a lot of reasons to keep it, and there's a lot of reasons to roll it. So let's take a look at why you should keep it. Here's the biggest reason for me is that, A, if you have a retirement account and you have 55 years of age or older, right, and you're looking to separate from service and retire at a younger age, prior to the 59 and a half, keep the money in the 401k plan, because there is no 10% penalty. So if I withdraw those dollars, if I separate from service at age 55, I avoid the 10% penalty. If you roll it into an IRA, you have to wait until 59 and a half, right, to get the money out, to avoid the 10% penalty. So keep it in the plan there. Another thing, Al, is that there's a risk of protection within 401k plans. So if you get sued or bankruptcy and things like that, you have a little bit better protection in 401ks than you do potentially in an IRA.
Yeah, you do. Although a lot of the states have kind of made this more consistent with the law, so there's not quite as much much benefit, Joe, as there used to be, but there still is a benefit. And for if you are have a profession or a job or something where you feel like there's some continuing potential liability lawsuits, you actually might want to keep your money into a 401k. But those are the couple reasons that you might want to stay and keep the money in the 401k. Let's talk about reasons to put it into an IRA.
Yeah, I think there's a lot more reasons potentially to roll the money into an IRA. Is that A, you have a lot more investment choices. So you might be stuck. Well, that's a double-edged sword there too, because some of you, if you have more choices, then you get analysis paralysis and you don't really know what funds to pick or what investments to pick. But in general, if I have an IRA, an individual retirement account, I have full control of the money. I can pick any investment basically that I choose besides, collectibles or life insurance. There's other benefits when it comes to holding IRAs. What else do you think? I think that's the biggest.
Well, that's the big one. Biggest.
Consolidation.
Yeah, I think simplification. Really, when I think of it, it's like if you have like 5 or 6 IRAs, and then maybe you end up with some prior 401ks. It's like I got 6 or 8 or 10 accounts. If you can put everything in one IRA, it's a lot easier to manage. So, Joe, another strategy is called net unrealized appreciation. When you have a company stock in a 401k. And this is where, if it's highly appreciated, there's a strategy where you can actually pull those dollars, pull that stocks out of the 401k, transfer it to your non-retirement account, your brokerage account. You do pay ordinary income taxes on what you paid for the stock, but all that gain becomes taxed at capital gain when you actually sell the stock. And for a lot of you, that's a big tax savings.
Yeah, that is missed often, because when you look, if you have company stock inside of your 401k plan, a lot of you that have worked for a company for a long period of time, is that you have some appreciation within that overall stock. So instead of selling it within the plan, you want to get that money out of the plan as fast as you can. Right? As soon as you retire, then when you sell that stock, it is taxed at a lot lower rate. So then you're getting more diversification here. So that is probably another phenomenal reason why you want to start looking at things when you get to retirement. Look at your retirement accounts and say, all right, do I want to keep it in the plan? Do I want to roll it out? Do I have company stock? Do I have Roth provisions in the plan? There's multiple things there's decision points that you have to make when you look at rolling money out.
We'll go over a net realized appreciation example just so you get what we're talking about. So this would be $100,000 of stock, and in the first column it's using the NUA. So you distribute that out to your non-retirement account. Your basis is $20,000, and so you got to pay ordinary income taxes of about $4,400. Your capital gains when you do sell the stocks about $12,000. Total tax about $16,400. This is assuming that you're in the 22% federal tax bracket. But compare it to not using the NUA. When you pull that money out, the tax is $22,000. So in this example, there's a $5,600 tax savings. In some cases, we've seen hundreds of thousands or millions of dollars in a 401k where the resulting tax savings is a really big amount.
Hey, we got to take a short break. Don't go anywhere, because when we get back, we're going to break some more strategies down that you need to know. But go to our website, yourmoneyyourwealth.com, go to special offer, and we have our IRA guide. So all of this is broken down in plain English. So if you're confused as I am, you can just go to the guide, and it's right there. Download it in the comfort of your own home. Don't go anywhere. Show's called Your Money, Your Wealth. We're just getting started. Hey, we're talking IRAs, RMDs, NUA, and all sorts of other good stuff, and we're trying to get you a master's degree in retirement accounts. Welcome back to the show, folks. Show's called Your Money, Your Wealth. Joe Anderson, Big Al hanging out. We got a lot more to go, but before we get into any of the meat, let's see how you did on the true-false question.
The required beginning date of your first required minimum distribution from an IRA is the year you turn 70 and a half. And that actually is false. Joe, when is that required beginning date?
The RBD, the required beginning date, is April 1st, the year following the year you turn age 70 and a half. But if you do that, then you have to take 2 RMDs.
2, right.
So they make it so complicated. People think 70 and a half, I have to start taking money out of the account, but that's not necessarily true depending on when your birthday falls. It's the year after you turn 70 and a half. And some of you, that might make sense, depending on what income level that you are the year that you're retired. Some of you, it makes sense to push it to the following year because you might be in a lower tax bracket. Some of you, it might make sense to take it in that year. So it all depends on your tax bracket. Al, speaking of RMDs, well, how the heck do you calculate this thing?
Yeah, let's kind of maybe run through it. So at 70.5, you have to take your required minimum distribution, and you're thinking, how do I calculate that? Well, what you're going to do is you're going to look at the balance of your IRA or IRAs at the year end, prior year end, December 31st, and then you have to go to this table to figure out the factor. So let's look at an example of $100,000 divided by 27.4, then your required minimum distribution would be about $3,600.
So you got to take a look at your account balance December 31st. So you have to look at all of your retirement accounts, IRAs, 401ks. You have to take distributions from them all, potentially. So here's my balance on December 31st. Here's that divisor that Big Al was just talking about, 27.4. So I got to take out $3,600. That equates to about 3.65%. So that's my required distribution year one. But guess what? It doesn't stop from there. Each year that I age, that percentage increases. Why does that increase? Because the IRS said, you know what, we gave you a tax deferral on that account for years. Now you have to start pulling the money out. I don't care if you need the money or not. We're going to start out slow, right? Because we want our tax money. But each year as you age, guess what? More dollars come out. And then when more dollars come out, guess what else happens? More taxes. So you want to make sure that you can control these RMDs in the future, because a lot of times this blows people up, Al.
Because, I mean, in many cases, folks have an opportunity to do, let's say, a Roth conversion, for example, because they try to get some of their money out of the 401k or the IRA to reduce the required minimum distribution. But a lot of people aren't really expecting this. They retire at age 65, let's say, their taxable income's low, and all of a sudden at 70.5, they have to take these required minimum distributions. And in many cases, they start their Social Security as well. So, Joe, it does get to be a pretty big deal.
And then here's another issue, is that when it comes to IRA plans, so many of you might have 3 or 4 different IRAs. It doesn't matter. You can pull one required minimum distribution out of 4 or 5. Let's say you have 5 different IRAs, and the aggregated combined total of those is that $100,000. Well, you could take one of those IRAs and pull the RMD from that one and leave the other 3 or 4 alone. But let's say if you have multiple 401k plans, maybe I've worked at 4 or 5 jobs and I never consolidated. I kept them in the 401k plans. That is not the case with 401k plans. You have to take a required distribution out of each of those retirement accounts. So with IRAs, you could say, I'm just going to take my required distribution out of one account. No big deal. With 401ks, you have to take a distribution out of each and every 401k or 403b that you have. We see this mistake often, is that, all right, well, here, I have 401ks and IRAs. My distribution is $10,000. I'm going to take one account and take the $10,000 out. You know, I satisfied my required distribution. But if you have multiple 401ks here, you're going to receive huge penalties. That penalty is 50%. It's 50% of the required distribution that should have been taken. They're not messing around. It's one of the most egregious penalties in the tax code. If you miss your RMD, you decide not to take it, or if you make a mistake, it's a 50% tax penalty. 50, Big Al, that's a pretty big number.
It is a big number, Joe, and the truth is it doesn't even stop when you pass away, because the kids or your spouse, whoever gets that IRA, is going to have to continue to take required minimum distributions, although there's different rules. If your spouse inherits your IRA, there's one set of rules, and if it's non-spouse, in other words, your kids, anyone that's not your spouse, it's completely different rules, Joe.
Yeah, when you look at this, so let's say if I was married and I had a spouse, and then that spouse passes. I have 2 options. I can say, you know what, I'm going to keep my retirement account in my spouse's name, or I can decide to roll it into my own name. The reason why you would want to keep it in your deceased spouse's name if you're under age 59 and a half, because if you're under age 59 and a half, you can keep it in the deceased spouse's name and you have full access to the money without a 10% penalty. If you decide to combine and consolidate, if you're under 59 and a half, guess what? Now you have to wait until you're age 59 and a half to have access to the money without that 10% penalty. Another reason not to keep it in the spouse is that, let's say the spouse was older. I'm 60 years old, my spouse is 70, and I keep it in the deceased spouse's name. I will have to take a required distribution when my spouse would have reached age 70 and a half, even though my spouse is dead. Then you have to keep track of every year of what your deceased spouse's birthday is, right? And take distributions. So in that case, you probably want to consolidate. But when it goes to a non-spouse beneficiary, Al, it has to say in the deceased name.
It does, Joe, and it's a whole different ballgame there, because now they don't want to have you put this inherited IRA in your own IRA. Let's say you're only 25 years old and you're thinking, gosh, I can take this inherited IRA, put it in my own IRA, and then I can wait till I'm 59 and a half. IRS says, no way. This was an inherited IRA. You got to start taking distributions right now. And so there is an opportunity to stretch that over your lifetime, but sometimes people mess that up, Joe.
That's a great point, because when you think about any other asset that you might inherit, I inherit a brokerage account. Guess what? I'm going to tell that brokerage account, hey, I'm the beneficiary or the transfer of death, or here's the trust. Let's just put it in my name. I'm not going to sell any securities. We're all good. I inherit a house, right? I'm going to switch the title. I'm going to move into the house. IRA. Oh, okay. Well, I have the IRA. I'm just going to put it in my own IRA. If you do that, it will blow up on you. Right? You cannot commingle that. Just as Al said, think about it. If I'm 30 years old and I have a 75-year-old deceased person's IRA, I can put it into my name by law. I can continue to defer those taxes until I'm 70 and a half. The IRS doesn't like that. So then I would have to put it into a stretch IRA, right? A stretch IRA all means it has to stay in the deceased's name, all right? So here's a quick example is what it looks like. So John Doe died, right? Deceased on whatever date that he died, August 1st. God bless. Rest in peace, Johnny, right? For the benefit of the non-spouse beneficiary. So it stays in the deceased's name. Now, Janice here's the beneficiary. She can do whatever she wants with that money, but she has to take a required distribution based on her life expectancy. So however old Janice is, if Janice is 20 years old, well, then she's got a very small distribution. If Janice is 70 years old, well, then it's going to be right around that 4%. It's a little bit more, but you get the gist. It has to stay in the deceased name. We see people commingle this because every other asset you inherit, you think, oh, all right, well, I'm just going to consolidate all this stuff. But retirement accounts, you just can't do it, Al.
Yeah, and Joe, with this new tax law, we thought the stretch IRA may go away, but they actually kept it. They retained it, so it's still available. And then we get the question is, well, how can I set up a stretch IRA? And the thing is, you have to die first. So you need to get your kids educated on what a stretch IRA means.
Yeah, you absolutely do not want a stretch IRA right now. You have to die to get that. We got to take a short break. Go to our website, yourmoneyyourwealth.com. Click on that special offer. What we're giving away is an IRA guide, 8 IRA things that you need to know to save your life or something like that. It's really catchy. Go to yourmoneyyourwealth.com. Just click on the special offer. You'll find it right there. We got to take a short break. Don't go anywhere. Show's called Your Money, Your Wealth. Hey, welcome back to the program. Show's called Your Money, Your Wealth. Joe Anderson and Big Al hanging out talking about IRAs, getting a master's degree today in IRAs. Before we wrap this show up, let's see how you did on this true-false question.
I'm allowed to donate my required minimum distribution directly to charity if I'm over 70 and a half and it is less than $100,000. And that actually is a true statement. It's a relatively new law. I think it came into being around 2012. You're allowed to take your required minimum distribution and send it right to charity. So that's what that means is you're not going to have to pay tax on it because it went right to charity. Now, if you need the money, then don't do this. But if you have extra money and you don't want to pay the tax on it, you can send it right to charity.
Yeah, I think, Al, too, right, this is going to be way more important this year. I think that's where you're going with this than probably any, with this new tax law.
Right.
Explain why someone would think about this now versus, donating another asset.
Yeah, it's a good point, Joe. And the reason is because we have, with this new tax law, a much higher standard deduction, $12,000 for a single taxpayer, $24,000 for a married taxpayer, and you're only limited to $10,000 for your state and property taxes added together. So the point is, a lot of people are no longer going to itemize their deductions, and if you pull the money out of the IRA, pay the tax on it, and then send it to charity, well, you pay tax on something that you're not going to get to deduct, Joe, because in that particular case, it's you're not itemizing.
Right. And I think, first of all, you want to give because you want to give. But the second benefit is that you get a tax deduction. Now, with these QCDs, think about it looking at, all right, well, if I want to give and if I'm just taking the standard deduction, absolutely, this is going to be a great strategy for you. Just directly from your retirement account to that charity directly, and you'll get a little bit bigger bang for your buck. Speaking of passing assets, not necessarily to a charity, but how about to the beneficiary? There's a lot of mistakes that we see when it comes to beneficiaries, Al.
Yeah, and I think number one, Joe, is it seems silly, but we see this all the time. Folks forget to name a beneficiary. And this happens. Sometimes you set up an IRA and you think, okay, I got it set up. I'm going to name the beneficiary later because I don't have time. And then you forget about it. And Joe, this is more common than you would think.
Yeah, and I think so sometimes too, it's like, well, who do I name? You know, if I'm not married, I don't have kids, and then do I name what's nieces and nephews? And you know what, I'll deal with it later. And then guess what? You die. And then the beneficiary is your estate. That's probably the worst place that your IRA can go to. So it depends on age what happens. If you're over 70 and a half, then it goes through intestate, and then that gets complicated. That's a whole nother show. But you just lose the stretch capability of that overall plan. So more taxes are going to go to the IRS than necessary. So always look to make sure that you name a beneficiary. Or you want to make sure that you have contingent beneficiaries, just in case that the primary beneficiary predeceases. Another weird thing, Al, is that let's say if you name your ex-spouse, but you want your ex-spouse to still be a beneficiary. I don't know if that happens. It does happen, believe it or not. But there's some weird, crazy rules there.
Well, there are, and that's really the second thing here is forgetting to change your spouse when you've gotten a divorce. And in some cases, it depends upon the state you live in. In some states, then the beneficiary, the ex-spouse, still remains as the beneficiary. In other states, like Arizona, for example, it's presumed that you've revoked that beneficiary statement because you got divorced, and you'd have to go right back in and do another beneficiary statement for your ex-spouse if that's in fact what you want to do.
And you got some simple steps, right, to managing your beneficiaries, Bud? What are those simple steps that people can do to look at this?
We do, and this doesn't probably seem that hard, but this is missed, so we're going to go through it. So number one is choose who you want to inherit your account. So typically that might be your spouse, or if you're not married, maybe a child or niece or nephew, brother, sister, mother, father, whatever it may be. So make sure you name that beneficiary. And as Joe, as you just said, make sure that you have a contingent beneficiary, because if your beneficiary passes before you do, then you really don't have anything, right? So that's number one. Number two is to decide how much money each beneficiary will receive. So you don't just have to have one beneficiary. You can have many beneficiaries. Maybe you got 4 kids and you want each of them to inherit 25%. And you don't have to be equal if you don't want. This is up to you, however you want to do it. Another one is make sure you complete those beneficiary forms. Not that complicated, probably takes you less than 5 minutes, but it's missed all the time. And finally, this is really a big one. You think you got everything covered? Make sure you review your beneficiary statements periodically, because things change. Your family may change. Your beneficiaries, your parents may be no longer living, your brother, sister, whatever. So make sure you look at these each time there's a life change in your life.
All right. Now, with that being said, it's time to ask the experts. This is by far the favorite part of the show, so let's get the experts in and we'll answer some questions.
All right, number one question is Robert in La Jolla. I want my 6 grandchildren to inherit my IRA. Is it better to make my family trust the beneficiary or name each of the children as beneficiaries? What say you, Joseph?
Well, I guess it really depends. If you want to control the money from the grave, so you don't trust your grandchildren to handle the money, then yes, you probably want to set up an IRA trust. Your regular revocable living trust, it's very complicated to make sure that you have everything documented correctly in the trust. So right off the bat, I would say no. I would just say, here's my beneficiaries, here's my contingent beneficiaries, here's the percentage that I want them to go to. Now, if they're minors, right, they're going to inherit some money, so they really don't have access to it anyway. The guardians are going to be able to control the IRA. But if you do want to control the money from the grave in regards to you don't trust them spending it or you want to control the spending, yes, you could set up a separate trust is what we would recommend to hold those assets. I think we got time for one more, Big Al.
This is Jack from San Marcos. My wife has a large percentage of her retirement savings in a Roth IRA. Can I take my required minimum distributions from her Roth?
No, don't do that. There is no RMD on a Roth IRA.
Well, first of all, and even if there was, no, you have to take it out of your own account, right? You have to take it out of your own IRA. You can't use someone else's Roth IRA to cover your RMD. It's just the answer is no.
Yeah, because an IRA is an individual retirement account. So each you and your spouse has its own different schedule. So you could be different ages. So your required distribution, your requirement is going to be different than your spouse. All right, that's it for us today. Hopefully you enjoyed the show. Hopefully you learned something. Go to yourmoneyyourwealth.com. Click on that special offer. We have an IRA guide that breaks down in a lot more detail everything that we discussed today. So hopefully you get a little bit more education. That's it for us. For Big Al Clopine, I'm Joe Anderson. You just watched another phenomenal episode of Your Money, Your Wealth. Have a wonderful day, and we'll see you next week.